Welcome to Ekesha's Foreign Exchange Made Easy class. Today is 12th session. Last day I solved some problems based on future contract. Today I will solve one problem and start calendar spread. Now come one problem. A UK company export to a Germany company worth of euro 4 million euro due after 6 months. There are three alternatives to be evaluated before export. Invoice amount in GBP at current exchange rate. Invoice amount using forward exchange rate to hedge the transaction risks. The invoice amount using future contract rate to hedge the transaction risks. I have already discussed what is transaction risks. Now come spot rate GBP euro. You see the exporter is of a company, UK company. So GBP euro is indirect code of in UK. GBP is the base currency and euro is the quote currency. GBP is the domestic currency. So the invoice amount of GBP at current exchange rate, first question, you should apply this rate, current rate. That is, since it is indirect quote, so euro 4 million will be divided by 1.1770, that is ARC's rate. 6-month forward premium, it is given 0.60, 0.055. Here the forward rate will be 0.60 will be deducted from 1.1750 and 1.1770. 0.55 is deducted from 1.1770. You will get forward rate. 6-month future contract is currently trading 1.1760, that is spot future rate. 6-month future size GBP 62,500. Spot rate and 6-month future rate GBP euro is 1.1785. Now come invoice in sterling using spot rate. Invoice amount is 4 million euro, that is 40 lakhs euro divided by 1.1770, that is equal to 33,98,471 pound. Since it is indirect quote, that is domestic currency is base currency and quote currency is foreign currency, euro, is divided by ARC's price to convert it to pound. Using forward rate. First of all, you find out the forward rate 1.1750 minus 0.0060, 1.1770 minus 0.0055 is equal to 1.169, 1.1715. So invoice amount will be at the rate of forward rate 40 lakhs divided by 1.1715, that is equal to 34 lakh 14,426. To find the forward rate, spot rate will be deducted by the discount. Here the forward rate will be, it is given. Using future rate, realized amount 40 lakhs euro divided by 1.1785, that is given the spot rate on expiry date. Spot rate on expiry date is equal to future rate on expiry date. That is equal to 33 lakhs 94,145 pound. To find out the lot size, euro 4 million to be converted to GBP, since the contract size is given in GBP. The conversion factor will be 1.1760, that is spot future rate. 40 lakhs euro divided by 1.1760 is equal to 34 lakhs 1360 pound. Number of lot 34 lakh 1360 pound divided by 62,500 pound is equal to 54.42. But you will take the lot size 54 and not the fraction 40.42. Future profit will be 1.1785, that is future rate on expiry date, minus 1.1760, that is spot future rate, multiplied with 54 lot number, multiplied with contract size or lot size. Contract size is 62,500. That is equal to 0.0025 multiplied with 33,75,000 is equal to 8,438 euro. To convert this euro, 8,438 divided by 1.1785, that is spot rate on expiry date, is equal to 7,160 pounds. Total received in future contract will be 33,94,145 pound plus 7,160 pound is equal to 34,01,305. So forward rate will be preferred because in forward rate the exporter will receive 34,14,426 pound. So it is higher than the future rate conversion. So the forward rate will be preferred. In indirect code, for some short position, if the matured future price is higher than spot future price, the exporter will gain. Just reverse the direct code. You should remember this. Now comes spread trading. Spread refers to the difference in prices of two future contracts. A future spread trade consists simultaneously buying one future contract, that is long future contract, and selling one future contract, that is short future contract. There are two types of spread trading. One is intra-currency pair spread, calendar spread. In this spread, both contracts have same underlying, that is, it is currency or equity of the one same company, but different maturity. Calendar spread is made up of long position in future contract on 1 month and short position in future contract in another month. It is computed with respect to the near month series. For instance, if Mr. X has, say, 3 short contracts in 1 month, first month future contract, 2 long contracts in 2 months, second month, and 3 long contracts in 3 months, future contract, he would be said to have 2 calendar spreads between first and second month. That is, Mr. X has 3 short contracts in first month and 2 long contracts in second month. So the calendar spread will be 2 between first and second month, and 1 calendar month between first and third month, because there remain 1 short contract in first month, and in third month 3 long contracts. Out of this, 1 will be taken as a calendar spread. The remaining 2 3-month contract would be treated as naked. A calendar spread becomes naked or open position when the near month contract expires, either of the legs of spread is closed. The calendar spread allows the processor to hedge their price risks to a large extent because they are combination of two opposite positions, while trader will look at the spread to capitalize on potential profit opportunities. Now come buying spread. Buying a spread in calendar spread strategy means buying a near month contract and simultaneously selling a far month contract. The strategy is adopted when near month contract is underpriced because it is long future contract and it will anticipated that market will move up, so they will gain. Or the far contract price is overpriced, that is anticipated that the market will move down, and in selling strategy the trader will gain. The trader aims to make profit from price difference between the two contracts. If the spread narrows or stable by the time of contracts expire, the trader will gain. If the spread widens, the trader will incur a loss because what narrow means the spread on the expiry date is less than the spread on the contract date, and widens means spread on the expiry date is higher than the spread on the contract date. Now comes selling a spread. In calendar spread strategy means selling near month contract where it is overpriced and buying firm month contract when it is underpriced. In the case of in this case, the spread widens by the time the contract expired, the trader will gain. If the spread narrows or stable, he will incur loss. That is, on expiry date, the spread is higher than the spread of the contract day, then the trader will gain. Otherwise, he incur loss. The trader adopted these strategies when the spread is not fair in both cases and square up the positions when the spread corrects and the contracts traded are traded at fair spread. At present in equity market, the system recognizes only calendar spread. The spread trading have some benefits. First, future spread are more balanced than a single contract. That means they limit risks and provides additional route to profitability rather than merely betting an asset that will move in single direction. Margins are lower in future spread than for trading a single contract, as net amount of value to be settled tends to be less volatile than outright price. Spread trading, buying a spread if it is wider then loss. Spread on expiry date, if it is wider then the trader will incur loss, and if it is narrow he will gain. And selling a trade, if it is wider on the expiry date then gain, and if it is narrow then loss. When spread wider spread means the spread on expiry day is higher than the spread on the contract day. That is, if the spread on expiry day minus spread on contract day is positive, the trader will gain, otherwise he will incur loss. That is in the case of selling trade. Narrow spread is just opposite of wider spread. That is, spread on expiry date is less than the spread on the contract day, if the spread on contract day minus spread on expiry day is positive, the trader will gain, otherwise incur a loss. It is in the case of for the case of buying spread. Now come problem. Intra currency spread, calendar spread. A trader decides to sell October currency future at rupees 72.50 and at the same time buy December future at rupees 73. On expiry day, October future price is trading at 72.90 and December future price is trading at 73.25. Now, October currency future. Sell the currency future at rupees 72.80 and on expiry date the future price traded 72.90 for in future selling future contract he will incur a loss of 0.10 rupees 0.10 and in December currency buy a currency future at rupees 73 and on the expiry date future price traded 73.25, so the profit will be 0.25 because the expiry date future price is higher than the future price at the time of contract. So profit will be 0.25 and you come to spread. Spread is difference between the two future price. That is 73 minus 72.80, it will be 0.20. And future next is 0.35, 73.25 minus 72.90, 0.35. It is selling spread. So the spread on expiry date, that is 0.35, is higher than the 0.20. So the trader will gain. If you see that 0.10 plus 0.25, net profit will be 0.15. Here you will see 0.35 minus 0.20, it will be 0.15. For one lot, it will be rupees 150. In selling case, if the spread on expiry date is higher than the spread on the contract day, the trader will gain. In this case, the spread widens, that is spread on expiry date is higher than the contract date, so the trader gains in this transaction. Now buying a spread. The trader decides to buy October currency future at rupees 72.80, at the same time sell December future at 72.20. On expiry date, October future price is trading 72.90 and December future price is trading 72.40. Now October currency future, buy currency future at rupees 72.20 on expiry date 72.40. So there is a profit 0.20. And December currency, sell currency future at 72.80, 72.90 is the expiry date future price. So here the trader will incur a loss of rupees 0.10. Now come to the spread. The spread is 0.60. That is 72.80 minus 72.20 is equal to 0.60. And next it will be 0.50, that comes from 72.90 minus 72.40. So in the buying case, if it is narrow, if it is lower than less than the spread on the contract day, so the trader will gain. That is 0.60 minus 0.50 is equal to 0.10. Here you will see the net profit will be plus 0.20 minus 0.10 is equal to 0.10. The total profit is per lot is rupees 100. In buying case, if the spread on contract day is higher than the spread on expiry date, the trader will gain. In this case, the spread narrows, that is, spread on expiry day is lower than the contract date, so the trader gain in this transaction. Calendar spread is one of the popular strategy employed on Indian exchange such as National Stock Exchange, NSE, and Bombay Stock Exchange (BSE). Buying a spread. A trader buys RIL Reliance Industries Limited April future at rupees 2280 and sell May future on, that is, at rupees 2295. On expiry day, April future price is trading 2300 and May future price is trading 2297. So come first April equity future. Buy RIL future at rupees 2280. Future price traded at 2300. So the profit will be, in the long future case, rupees 20. And in May future price, sale RIL future is 2295 and 2297, that is rupees 2 is the loss in the selling the future contract. So net profit will be rupees 18 and the spread will be for on the contract day will be 15 and the spread on the expiry date is -3. So 15 minus -3, that is, it is narrow. It is less than the contract day spread. So 15 minus -3 is equal to 18 will be the profit. Per lot, the 250, 18 into 250 lot size is equal to rupees 4500. In buying case, the spread at the time of contract is higher than that of expiry date, so the trader will gain. Selling a trade spread. A trader sells RIL April future at rupees 2240 and buys May future at rupees 2230. On expiry date, the April future price is trading 2250 and May future price trading 2245. Now comes April equity future. Sell RIL future is at rupees 2240 and future price traded 2250. So it is a selling future, short future contract. So the trader will incur a loss of rupees 10. And in buying case, 2230 and future price on the expiry date 2045. So you will gain of rupees 15. The net profit will be 5. And come to spread, it will be -10. Contract day -10 and on expiry date it is -5. So here it is a selling a spread. So -5 is higher than rupees -10, spread -10. So in selling -5 minus -10 is equal to 5. So profit will be 5. The lot size 250. The total profit will be rupees 1250. In selling case, the spread at the time of contract is lower than that of expiry date. The trader will gain. Intra-commodity spread, calendar spread. Buying spread, a trader decides to buy October gold future 1 kg at the rate of rupees 50,700 per 10 gram and simultaneously sell December future of 1 kg at the rate of rupees 50,800 per 10 gram. On expiry date, the October future price is trading 50,900 per 10 gram and December future price is trading 50,950 per 10 gram. Here, this is calendar because the underlying asset are same. That is, here it is gold and the future price one is October and December. Long future on October and short future in December. The maturity is different. On October gold future, at the buying gold future at rupees 50,700 per 10 gram and future price traded on the expiry date at rupees 50,900 per 10 gram. So the profit will be in the long future case rupees 200. Sell gold future at 50,800 and future price traded on expiry date 50,950. So the loss will be 150. Now net profit will be 50. Here come to the spread. The spread is 100 on the contract day and 50 is the spread on the expiry date. So it is narrow. If it is narrow on the buying spread, then the trader will gain. That is 100 minus 50 is equal to 50. Or in the case of selling the trade, the expiry date spread minus a contract side spread, if it is positive, then the trader will gain. In the case of spread narrow, the spread, that is the spread on expiry date, is lower than the contract date, so the trader gains in this transaction. Intra-commodity spread, calendar spread. Selling a trade. A trader decides to sell October gold future of 1 kg at the rate of rupees 50,750 per 10 gram and simultaneously buy December future of 1 kg at the rate of rupees 50,800 per 10 gram. On expiry day, October future price is trading at 50,800 per 10 gram and December future price is trading 50,900 per 10 gram. Now comes sell gold future on October 50,750 per 10 gram and on expiry date the future price traded at rupees 50,800 per 10 gram. It is a short future, so the trader will incur a loss of rupees 50 per 10 gram and buy gold future at rupees 50,800 per 10 gram and future price traded on expiry date at rupees 50,900 per 10 gram. So he will gain rupees 100 per 10 gram. So net profit will be 50. Now come to the spread. If it is a it is a selling a spread. The spread is on the 1st October is 50 and on expiry date it is 100. So 100 minus 50, if it is positive, is equal to 50. And in the buying case, 50 minus 100. If it is buying case, then the spread on the contract day will be higher than the spread of the expiry date. Then it will be positive and reverse will be negative, that is loss. In the case of spread widens, the spread on expiry date is higher than the contract's date, so the trader gains in this transaction. Intercommodity spread. An intercommodity spread is made up of long position in the future contract in one commodity and a short position in future contract in a different commodity, but it is economically related commodity and both contracts have same maturity. Intercommodity spread involves buying and selling future contracts on raw commodity against future based on the derived or processed commodities such as soybean and soybean oil. Soybean oil is crushed from the soybean, corn and wheat. It also attempts to take advantage of the value differentials between two and more economic related commodities such as gold and silver. This is related commodity and the maturity date are same. Selling at spread. A trader decides to sell October silver traded future at the rate of rupees 75,750 per 1 kg and simultaneously buy October gold future of 1 kg at the rate of rupees 50,900 per 10 gram. On expiry date in October, future price of silver is trading 75,800 per 1 kg and October gold future price is trading 50,980 per 10 gram. So October silver future sells silver future 75,750 per 1 kg and future price traded 75,800 per 1 kg. So the loss will be 50 for selling a short future contract. Now October gold future at rupees 50,800 per 10 gram and future price traded 50,980 per 10 gram. So profit is 180. Net profit 130. Now come to the spread, that is minus 24,950 and minus 24,820. It is higher than this, so the profit will be 24,820 minus 24,820 minus 24,950. It will be positive 130, so profit will be 130. Today I stop the class. Next day I will discuss this calendar spread and also solve some problems on future and forward contract. Thank you.